welcome to Money Talks. We have one very simple goal here, and that's to make you richer. On tonight's show, we'll test out whether we should fear an inverted yield curve in the bond market, which suggests a global slowdown and a meltdown for stocks is on the way. To do this, we have HSBC's Chief Economist in Australia, Paul Bloxham, who will hopefully hit all these scary curveballs threatening the economy and stocks to the boundary. And then I've asked Bell Direct's Julia Lee to get looking for the kinds of stocks that you should be thinking about if a recession is coming, or if you just want to make your portfolio more defensive rather than aggressively pursuing growth. But first, my interview with Paul Bloxham earlier today. Paul, thanks for joining us.
No worries.
Well, there are worries, in fact, because there's worries about an inverted yield curve, which most people don't understand, which is apparently a signal that a recession could be coming. What's your reaction to that threat?
Well, certainly it's something we're watching very carefully because, as you say, the inverted yield curve in the US has been a pretty good predictor of US recessions. But at the moment, if you actually look at where the bond market is, it's not actually set up for predicting a recession in the US. It's predicting a downturn. So, look, we've got in mind that the US economy is slowing. It's slowing from the rapid rates of growth we saw last year, partly because that big fiscal stimulus is starting to wear off, and we think growth will slow this year and into next year back towards a roundabout trend for the US economy. But we're not forecasting that it's going to deliver some sort of significant downturn, just a slowing back from above trend rates towards a trend rate of growth.
Now, because the American economy is so important to the global economy, and of course Wall Street is very important as well, because if Wall Street went into a substantial bear market, the world would probably follow to a large extent. When do you think the next significant global recession might show up?
Well, this is the trickiest question. I mean, we don't really know. Economists we find it hard to predict when the next downturn is going to come. We look for the signs, and as you say, that the inverted yield curve is something we're watching very carefully at the moment. I think the other thing to keep in mind in this conversation at the moment is, of course, that the Chinese have just delivered a really large fiscal stimulus, and the Chinese economy is starting to show signs of stabilising after having weakened through last year. We just got the PMI for China for March, and that lifted. So we're of the view that China's growth is going to pick up pace into the second half of this year. So at the same time, as you say, the US economy is still a very big force in terms of the overall global picture. The Chinese economy is also a big force, and in particular, of course, a big force for Australia. So we're a bit more optimistic on the outlook for China, and we think China's growth will lift into the second half. That should prevent us from going into something that's closer to a hard landing globally.
Do you think the trade war and the rhetoric around it hasn't helped the global economy?
Well, certainly, if you think about the factors that have been slowing down global growth, I think there are three key things. I think the first one is you should always have expected global growth to slow a bit anyway, because the US delivered this very large fiscal stimulus last year, the big corporate tax cut, and so they were running well above trend. So heading back towards something like trend makes a lot of sense. Yep. I think the second factor is, think about last year, we had the Fed lifting rates quite aggressively. They lifted the policy rate by 100 basis points, and that delivered tighter financial conditions. And of course, those tighter financial conditions flowed across the world as well. It wasn't just a US story, so that slowed things. And China was also tightening up its settings as well through last year. That was slowing growth. And then, as you say, the third factor I think that was at work was the ratcheting up of the trade protectionism and the challenges that presented. Of course, that's weakened the manufacturing cycle. So the key question is, where do those three things go from here? Well, the first one obviously is going to keep rolling off in terms of weakening growth, because we have to head back towards that sort of trend rate. The Fed has backed away, has turned a lot more dovish. China has started to deliver more policy stimulus and loosen the settings, in particular a large corporate tax cut. And the trade policy, what's still a watch point. We have to watch and see how that all plays out. But things look as though they're a little bit better than they have been, certainly towards the tail end of last year.
Now, one of the reactions I'm sure some of my viewers will be having, and they tend to be the people who troll me on Twitter, is that they believe that mainstream economists like you, and they call you MSMs for some reason, you seem to be ignoring the high level of debt out there that must come back eventually and deliver a day of reckoning. Now, I'm sure you do think about it. How do you manage your forecast against a backdrop of unbelievable levels of debt right around the world?
Well, high debt levels are certainly potentially a constraint on growth, but you've got to keep in mind that while debt is very high, interest rates are extraordinarily low. So servicing and funding that debt is seemingly easier than it's been in the past. That's not to say that at some point in time the high levels of debt don't come back and weaken growth. Of course, you're pulling forward growth from the future. But while interest rates are still very low, it all seems to be quite manageable, and that's why we're still predicting that growth can continue.
Okay, let's move on to the budget on Tuesday, and for the first time in my life I've seen a central bank basically imploring the government to give tax cuts. Is this something that's quite unusual on your recollections as well?
I think it is quite unusual for the RBA to so clearly endorse the government in delivering tax cuts. We saw one of the assistant governors, Lucy Ellis, give a speech at a housing conference and speak all about tax policy rather than housing. So I think it's clearly the case the RBA would like some fiscal support, but I think it also makes a lot of sense at the point in the cycle we're at. So if you kind of look at what's going on in the Australian economy at the moment, it's not that we lack income growth. Nominal GDP growth is actually picking up pace. It's just that it's in the corporate sector, where in the mining companies in particular, it's flowing through to the budget. It hasn't really gotten through to the household sector like we've seen in the past. So I think the RBA is of the view that the income's there, it just needs to be spread to the household sector a little bit more than it has been. And I think it would be sort of optimal policy for us to get a bit of fiscal support for the household sector at this point in the cycle, rather than the RBA having to cut its cash rate further, because I think that presents a lot more challenges. The RBA cuts its cash rate, it doesn't necessarily have the same sort of effect it's had in the past. As we get towards the lower nominal bound that they're going to face, it's going to have a diminished impact on the economy. And also, I don't think if the RBA cut its cash rate, that would necessarily get fully passed on by the banking system. So I think there's lots of challenges to cutting interest rates further. It's probably optimal that we see a fiscal response instead, and the RBA has clearly presented some endorsement of that.
And what do you say to those people who say, well, hang on, we're just getting into surplus and you're giving it away? Is it a wise thing to give it away at this time in the cycle?
Well, I think it is. I think, we're talking about the global economy in a downswing. Global growth is clearly slowing. Local growth has weakened, and the business surveys have weakened. I think it makes sense to get some support for the economy from policymakers, and I think at the moment an optimal response is fiscal rather than monetary. To those people who say we're just back in surplus, we should try and stay in surplus, I think that sort of in some ways we shouldn't be so focused on that zero line, on that surplus or deficit line, that the thing we need to keep in mind is what is the budget being used for? That's what it should really be. That should be the question we're asking. And so, if we get policies that are delivered through the budget that help to support productivity growth, tax cuts I think should be part of that, because it helps to sharpen incentives, encourage more people to move into work or do investment, but also a focus on infrastructure investment. If it lifts productivity growth in the medium term, then I think it's a helpful thing for the government to be doing.
Okay. A year or so ago, I supported you when you said, we can create a lot of jobs and the job market's getting stronger, and you absolutely got that right. But the growth didn't last. The economic growth part didn't last, and wage rises haven't happened. And for someone who's right on the labour market, generally you'd get all three, wouldn't you? You'd get rising wages and you'd get strong economic growth. What's so unusual about the current economy?
Look, I think there are a couple of things. Firstly, I think the statistics are all running in very different directions at the moment, so I think it's very hard to have a very clear view. As you say, the labour market has had a fair bit of positive momentum, and that's continued. Job vacancies are still at a record high as of the first quarter of this year. The unemployment rate's at an 8-year low, so we think the labour market's giving us this sort of read that the economy's got a fair bit of momentum. The GDP statistics, as you pointed out, were very weak in the second half of last year, but we think that slowdown might be a bit overstated, actually. We don't think that necessarily that the economy slowed quite as much as those headline statistics suggest. Keep in mind there are lots of different measures that go into calculating GDP, and GDP typically is revised up. We know that 3 years later the GDP numbers are usually revised up by 0.5 percentage point. So we're of the view that actually GDP might be a bit understated at present. So we're sort of arguing that the labour market's giving us a clearer read, and the growth hasn't slowed quite as much as those headline statistics suggest. But you're right. I mean, we're certainly in a world where things are acting in a bit of a different way, and I think the clearest evidence of that is wages growth, where we've had a tightening labour market. We just haven't had the same sort of pickup in wages growth that we've seen in the past, but we're not alone. This is happening everywhere. This is happening across the world. It was happening in the US. It's taken the unemployment rate to fall to a 5-decade low to really get some momentum in wages growth. It's been happening in Europe. It's been happening in Japan. But likewise, in all of those countries, we are actually now seeing that with unemployment rates at very low levels, they are starting to get a pickup in wages growth. And I think you're starting to see it here too. It's just happening very slowly. I mean, if you look at the wage price index, it's running at 2.3%, up from a low point of 1.9. You might say, well, that's actually, you know, a very modest rise, but it is the beginnings, I think, of a pickup in wages growth that we're expecting to keep gaining momentum.
And do you think this unusual economy, which we're seeing right around the world, is partly related to the age of the internet, the globalised economy, where people are now, for example, even getting bookkeeping services from Bangladesh? These are sort of structural changes to an economy that could be producing unusual things like smaller wage rises, but at the same time people are buying stuff like never before at much lower prices?
I think that's right. I think a lot of this has to do with globalisation and technology and the way that's increased competition in labour markets and also increased the perception of competition in labour markets. So workers are less willing to demand a wage rise because they see more competition out there. Firms are less willing to give a wage rise because they can find ways to produce without necessarily needing to give a wage rise and find other ways to be profitable. So I think that's right. I think technology and globalisation have changed the way the labour market operates. But saying all of that, I think you can still say that at some point, if you absorb enough labour into the workforce, if you employ enough people, you do start to get a bit of upward pressure on wages growth. It tells you that the laws of supply and demand still work. Okay,
so I can share my Twitter trials with you. I'd love you to tell me how much you think Sydney and Melbourne house prices might fall for across this, you know, peak to trough situation we've got now, and explain to us why our household debt levels don't come up on the radar screen of all the lenders overseas who are happy to lend money to us.
They're two great questions, and I think, you know, that the first one about the housing market and when it's going to start to stabilise, we don't really know the answer to that, of course, but our view is that with a labour market that's continuing to improve and a lift in household incomes, eventually at some point first-home buyers are going to start to come back to market, and we think that we're seeing some really tentative signs that might be starting to begin already. So with that in mind, our house view is that Sydney house prices come down by about 16% peak to trough. We're down 13 already, so we're thinking that the housing market starts to stabilise in the second half of this year, and in Melbourne about the same. We think a 16% decline. We're down 10 already, so again stabilising in the second half of this year is what we've got in mind for the housing market overall. In terms of household debt, I think the key thing that we've learned, and the thing we've been sort of talking about for quite a number of years now, is it's not really the aggregate level of household debt that matters, it's the distribution. It's who holds the debt that matters. If people who hold the debt are able to continue to service that debt, then household debt's not as big of a problem as it otherwise would be. And we've seen a 13% fall in Sydney house prices, but very few signs of rising distressed sales or rising loan arrears, and we think a large part of that comes down to the fact that the debt has been fairly well distributed. We know the bulk of the debt is held by the upper income earners. We know that we've had tightening lending standards over a run of years. We know that the average mortgage is prepaid by about 35 months. So we think the household debt story is really all about distribution rather than level, and the distribution is still quite favourable, and that's being tested right now, and the evidence is that actually, even though house prices are falling, households are able to continue to service their mortgages.
Yeah, and it seems to me that international financial markets aren't afraid to invest in Australian banks.
It seems, indeed.
Thanks very much for joining us.
Thank you.
Well, that was Paul Bloxham, who's the Chief Economist for HSBC here in Australia. Now, after the break, Julia Lee shows us how she'd play stocks ahead if a recession showed up. Welcome back to Money Talks. I'm Peter Switzer. I asked Bell Direct's Julia Lee to tell us how she'd play any upcoming recession in terms of stocks that she'd chase, and she joins me at the desk. Thanks for coming in, Julia.
Always a pleasure, Pete.
Okay, a lot of people have heard this about inverted yield curves. In a nutshell, what is it?
An inverted yield curve, well, a normal yield curve, first of all, is where long-term rates are higher than short-term rates. So that makes sense. An inversion is simply the opposite, where short-term rates are higher than long-term rates. Now, we're seeing an inversion in the yield curve because interest rate expectations.
And what is the yield curve?
It's just where short-term versus long-term yields are, bond rates. And it's because people are expecting the Federal Reserve to cut rates. And I think the thing to remember here is that the Federal Reserve is looking to cut rates to support growth. It's not trying to dampen growth. And sometimes when inflation runs away, the Federal Reserve or central banks get a little bit excited in terms of clamping down. And that's where the risk of recession rises.
They raise interest rates too quickly, don't they? They choke off everything.
Yeah, and the amazing thing is in the US since 1956, before 1956, it didn't particularly work so well. An inverted yield curve has happened before the peaking of equities. So equities peaks after the inverted yield curve, and then a recession tends to follow around about 7 to 14 months after that. Yeah,
okay, all right. So, but it's not 100% certain, is it? You can get a slight inversion and then some months later it flips around.
Well, you get a very early signal. So it's a bit hard to time a recession using an inverted yield curve. Because if we think about the global financial crisis, we first got inversion of the yield curve in 2005, and then again in 2006, and then again in 2007. Of course, the global financial crisis really hit in 2008.
Okay, it sounds like they're putting the finger out the window trying to work out which way the wind's blowing. Anyway, you're right, there is a bit of history there. And that's why I asked you to think about how you would approach stocks if you thought a recession was coming.
I think, first of all, you have to look at short-term versus longer-term. Short-term, it means that equities will probably go on to a new high. So equities in the US, and short-term, it's probably quite positive for the share market. In fact, we saw a number of stocks reaching all-time record highs. Some of the miners even reaching multi-year highs today. Rio Tinto reached an 11-year high. BHP Billiton also reached around about a 6-year high on the market. So look, it should be a good thing for stocks in the short term. In the medium to longer term, it does depend on whether we do see a slowing down, and a slowing growth scenario, of course, is a much more difficult one for equities. But then the general rule of thumb is if we do get a recession, you buy 6 months into that.
Okay, all right. So you let the recession run, let the stock market fall. After about 6 months, you start buying at the low points.
Pete, this is the exciting things about markets, because for me, cycles are absolutely normal. These economic cycles are a normal part of investing. And if you understand them, you can use them to try and harness the growth opportunities.
Yeah, and they're great as long as you don't lose your job and lose too much money. Now, we go to an ad break in a moment, but one group of stocks you don't like ahead of a recession would be banks. Tell us why.
Well, banks, I guess, derive their value from economic growth. So a recession means that growth is slower, so the banks are impacted. But in particular, the inversion of the yield curve is difficult for banks, because if you think about banks, they really borrow money and then they lend it out. So they borrow at short-term rates and then they lend out for long terms. So a flattening of the yield curve means that margins are being squeezed, and an actual inversion of the yield curve means that margins are being hurt. So if you have a look at last month, the worst performing sector in the US was the financial sector, the banks being particularly impacted. And here in Australia, Commonwealth Bank was down 7% last month. So the inversion of the yield curve, we'll continue to see that inversion, will eat into the bank's margins.
Okay, so that's a stock that she doesn't like, but coming back after the break, she'll run us through the stocks that she thinks are a good buy if you think a recession is coming, or if you just want to get simply defensive. That after the break. Welcome back to Money Talks, and we're talking about stocks you might buy ahead of a recession. Now, you think that the dollar often will fall as a recession comes on, and that gives you an interest in certain stocks.
Well, if we do see a slowing down globally, unfortunately, the Australian dollar is seen as a growth currency. So you do see a weakening of the Aussie currency. And instead, money goes into things like the Japanese yen, the US currency, and the Swiss franc. The weaker Australian dollar, of course, is great news for exporters. So if you're looking at some of those global leaders like CSL, ResMed, Amcor, which still has to bed down that Burmese acquisition, which will see North America becoming its largest segment, then all of these companies will benefit from that weaker Aussie dollar. So
okay, talk us through the stocks that you'd like to be holding going into recession because of a currency benefit.
Look, I know that Macquarie Group is known as a growth stock, but I think the great thing about Macquarie Group is its ability to shift from the growth areas of its business to the more annuity style or the safer areas of its business. So look, I think the weaker Australian dollar is will benefit Macquarie Group. And look, it saw an all-time high on the market today, and it has this great entrepreneurial ability to be able to adjust to market conditions and also to shift capital quickly, and I think that's a key. So,
but imagine if we had a recession and then the stock market dropped, say, 25 or 30%. Macquarie would actually still lose, wouldn't it? It couldn't resist. It has to go down. But we're going at a slower rate, do you think?
I think if you're talking about just a recession in Australia or whether you're talking about a recession in the US and Australia. So if it's just Australia, look, I'd be tempted to stay in Macquarie Group. But if we're talking about a North American recession, then that would be a different scenario.
Yeah. And so you also like Newcrest, don't you?
I do. I think one of the things that we don't talk a lot about is how well the Aussie dollar gold price has done over the last 6 months.
Yeah.
The Aussie dollar gold price has benefited not only from gold prices going up, but a weaker Australian currency as well. So it's gained about $200 in Aussie dollar terms. And where you want exposure to here is ASX-listed gold miners who have their assets here in Australia, so mine in Australian dollar terms, and then sell their product in US dollar terms. So, look, I like Newcrest Mining. It's a top 10 producer in the world, so one of the big ways to get exposure. They've just bought into Red Chris as well, which gives them another lever for growth. So if you want to go on the large cap side, Newcrest Mining, and on the small cap side, probably Gold Road, GOR. They're in the Yamana belt over in WA. So looking at the Gruyere resource.
So, and what's the ticker code?
GOR.
GOR. And we should say this, if your scenario is right, that we do get a recession eventually and the dollar falls, that would be very good for Newcrest because in a recession, they chase gold anyway, and with a lower currency, that should help Newcrest.
Yeah, it depends on how severe the recession is, because if it's extremely severe, then...
I'm talking global recession here, right?
Everything's sold off. Yeah. But in comparison to different sectors, gold is certainly seen as a safe haven, and especially initially when we get the jitters, gold stocks tend to be beneficiaries. Of course, if you see a sell-off of the whole market, like we saw during the global financial crisis, even the gold miners eventually...
So that becomes a buying opportunity, and hopefully that we will tell our viewers when to get out, maybe a week before the crash, and then they have all their cash, and when it gets to the bottom, we say get back in, and we make them lots of. That would be a nice thing, wouldn't it?
That sounds good. But don't forget China as well, because China has a very different cycle to Australia and the US, and whereas the US cycle is probably peaking, China's probably bottoming.
But in the GFC, China went down too, didn't it?
It did, but it's been down over the last few years. So he has been going through all this pain, and it now looks like some of those stimulus measures are starting to take hold. So a strong argument for diversification. Julia Lee, Bill Direct, thanks for joining us. Pleasure, thanks Pete. Okay, that's the show, and I'd like to invite you to the Switzer Strategy Days in Sydney, Melbourne and Brisbane in late April and early May. We will have many of the fund managers you see on the show who will explain how they pick their stocks and create investment strategies, and they will be available for your Q&As. Go to www.switzerevents.com.au and check it out. I'm Peter Switzer. Thanks for joining me. See you next week.